Welcome. Today is Thursday, November 4th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. The Daily Five, as you know, is the show where we talk about the five most important charts in our work this week. And we've got a few doozies here. Chart number one, I want to kick off with what I think is a pretty important new signal we just received, especially if you've been on the fence and wondering if this bull market's going to carry forward. Chart number one is actually a chart describing or illustrating the Dow Theory buy signal, which was just confirmed on Tuesday, when Avis Budget Group, the car rental company, soared 300% to about $545, taking the transportation index up some 2,000 points to make a new all-time high, confirming the high in the Dow Industrials. Now, here's the importance and the backstory of this thesis. Charles Dow, who many know as the founder of the Wall Street Journal back in 1889, famously observed that when the industrials were engaged in a sustained advance and making new highs, that the transports would confirm their bullish trend by also making new highs. But when the transports actually failed to make a new high along with the industrials, the bullish trend in the industrials would have a tendency to fail in fairly short order. So what Charles Dow deduced is that if the producers of goods were seeing an increase in demand, then the transporters of those goods should also see an increase in demand. And thus the market would reflect those underlying fundamentals in the pricing of the stocks. And therefore, the confirmatory evidence of these two indices, both making simultaneous new highs, is a significant bullish signal and should give us confidence in what I think is going to be a bullish resolution here going forward. And so with that, let's take a look at chart number two today. Chart number two goes back to our ongoing, and I should say work in progress. Elliot Wave Principle is always a work in progress. We're always documenting the market's action, and then we're attaching some labels to the waves, the ups and downs of the market within the context of this impulsive and corrective sort of dynamic of play that goes on with markets over various degrees of trends. And so what R and Elliott proposed years ago is that the market moves impulsively in five waves to define the direction of the trend, and then corrects in a three-wave pattern to consolidate those gains before the next up move goes into play. And what we had been postulating back in the August through October period was that maybe we were in this period of consolidation, and perhaps it was maybe even a substantial top, perhaps a major top. We weren't sure, and so we had kind of a bull case, bear case scenario, and it looks like the bull case has played out with a breakout to new all-time highs achieved on October 20th, which gives us confidence that the count now should be labeling the September 2nd high in the S&P 500 as a wave 3 advanced top, and the pullback to October 4th is a corrective wave 4. And so the chart on the left here is primary wave 5. It's going from the February 2020 period to present. So really documenting that entire primary wave 5 off the March 2020 lows. And so we're now some 18 months into this advance, and we think the advance can carry forward to perhaps as high as 4,800. Now, how will we get there? The chart on the right actually blows up this final move off the October 4th lows, looking really just at intermediate wave 5 and how it's progressed. And we see this progressing, as I've labeled it, in kind of a multi-degree minor, if not a minuet level of trend. And we think we're getting very close to that minor wave 3 high. Maybe it occurs today, maybe it occurs next week. But once we do find that terminal point in minor wave 3, we should get a pullback of at least 38.2%, a Fibonacci level that might come back as deep as, say, 45.20 to fill the gap that's open. Now, you might notice that there are about 4 open chart gaps, and they don't have to be filled. But, if history's any guide to the future, very likely most, if not all of them, will be filled at some point in time. But I think a pullback into that, 45.40 to 45.20 range is probable, and that we'll then see another liftoff to break out to new highs. And I think the ultimate high here could be S&P 4800. We get a good count, the breakout above the September 2nd high, and using the October 4th low is kind of that measure point. We can get a measured move to approximately 8,400. We like that as a next reasonable target, and we would be long and strong on the way to 4,800 based on this information today. So let's take a look at chart number 3 to figure out how we might play this more specifically. As everyone who's followed our work knows, we do a very deep dive into sector rotation, really weekly, but we publish it certainly monthly. And what we've noticed in the last month, and this chart was really taken from our November 1st review and outlook publication, where we see financials, discretionary, and energy breaking into the leading category. And while we have seen a little bit of a pullback in financials as rates have subsided, energy is accelerating higher and up and to the right. And very surprisingly, we've seen an explosive move out of consumer discretionary, while almost everything weakens and lags, except for those 3 sectors. So what we wanted to do is really isolate this move out of discretionaries, which we think is extremely impressive. It's that nice 45-degree angle, slicing right through the median line in the graph into leading quadrant territory on the relative rotation graph. And just for those who aren't familiar, we're looking at all of the 11 GIC sectors versus the S&P 500. And what the relative rotation does is it really shows us what sectors are leading, which are weakening, which are lagging, and which are improving. And we like that leading quadrant for new money for the next 21-day trading period. And so we're going to focus here on names in the discretionary space on chart number 4. So looking at chart number 4, what we've done is we've screened through the 78 odd constituents of the consumer discretionary space, and we've isolated those that are either in the leading quadrant already and beating the S&P 500, or appear poised to move in that direction in the not too distant future. Those that are seeing huge acceleration and momentum off of lows, and maybe falling short of their peer group for now, but in a position to see significant enough improvement that we might see them cross over into the leading categories soon. When I look at this chart, there is one that really stands out to me as being the most important chart, or the most important stock, and that is Tesla. Tesla is head and shoulders above the rest of the peer group. It is pointed up and to the right, leading the group in terms of its relative strength and relative strength momentum. So I thought what we do is really take a deep dive look at Tesla. So chart number 5 really digs into that a little bit deeper. And what we can see from this chart, this is a 3-year weekly chart, is that Tesla had a 5-wave advance, that impulsive Elliot Wave advance from about mid-2019 into early 2021. So almost a 2-year move that took the stock from around $37 up to about $900. And then we got a consolidation. That consolidation actually saw its lows occur within a month, but traded sideways, or more or less sideways, for about 9 months. And so, the breakout that we saw a couple of weeks ago to new all-time highs above that 900 resistance level really resolves that 9-month base formation. Now, there's a couple of ways that we can play this. The stock is obviously very volatile. It's had an explosive move out. And, investors might want to, those who don't already own the stock and would like to own the stock long term, might consider scaling into it or waiting to, build positions on weakness. But frankly, we've already seen our first initial target of around 1262 nearly met today. We've gotten up to 1243, so we're about $20 away from it. So what we've done is we've kind of looked at this thing and said, gosh, if we take a look at the last two big breakouts, we've had these, multi-week huge upside moves in, with those big candles, and I've circled them in red, and we've kind of got a repeat of that. What is noteworthy is that those were not the end of the move. Those were the beginning of the move. And so what I think is we've just seen this first movement. And while we could get some consolidation here in the days ahead, I believe that those will be setups for much, much bigger moves. And so we've used a little exotic math that was developed by a guy named Art Scleroux. Art Scleroux wrote a book back in the 80s, I think around 1980, actually, looking at ways to forecast upside prices in equities and commodities. And he came up with a formula that he described as the rule of 7. Now, the rule of 7 gives us an ability to project multiple price targets up substantially higher. Our first objective using the rule of 7 is 1328. Second is 1661. The third is 2327. And the fourth is 4,324 longer term. Now, it wouldn't surprise me at all to see Tesla show up as, a $2 trillion market cap a year from now. But longer term, it wouldn't surprise me to see it as a $4 trillion market cap. Now, investors might consider using a trailing stop loss here, and we would use the 10-week exponential moving average as our risk budget from an investment perspective. A weekly close below that level, I think, would be reason to exit the position. But based on that and using our long-term, actually just using the midpoint of our rule of 7 targets, we get a 5-to-1 positive risk skew. And I think it's worth taking the risk. Again, I would use weakness to build positions. Traders who have a shorter term perspective might consider using a daily close below the 8-day exponential moving average as their risk budget. So with that, I want to just put a shout out to viewer Lewis, who sent me a very nice book that was written by Art Scleroux. And if any of our viewers would like to get that, it has a very detailed outline on how to calculate the rule of 7. Email me at jhuge@jwhinvestment.com, and I will happily send you a copy of this PDF file. You can also follow me on Twitter at @alpha_insights to get more insights as to what our work is all about. So with that, I thank you for viewing, and I wish you all good luck trading today.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.